Good evening, everyone. It's 9 p.m. Sunday, July 9th, 2017. This is James coming to you from Dividend Stock Talk, where we talk about investing for cash flow, weekly cash flow and monthly cash flow using dividend stocks. Why? Because dividend stocks have a history of being safe, secure, and continually paying their investors a portion of the profits. That's where dividend comes from. It originally started back in the early 1600s with a company called the VOC, or the East India Trading Company. I think that's what it was. The British, anyway, the East India Trading Company. They went door to door selling shares of the stock, of the company stock, to investors, so that they could share in portions of the profits, and that's where the dividends came from. Well, at least that's what my knowledge brings me to. Anyway, I don't know where I'm going with that one, but anyway, here we are, Sunday night. Tomorrow's a new trading day. We got a lot of interesting stocks to look at tomorrow, but not a lot of weekly traders next week, I believe. Well, let's just jump right on into it and see what we're looking at. We are going to try to focus on simplicity at some point in this broadcast, because I had a couple of questions from some people that didn't quite understand exactly what it is we do, why investing is a good thing, why it's important to invest, and why invest the way I do. I don't know. So let's just jump right in and see what we're looking at this week. So this is, like I said, Sunday, the 9th of July. Tomorrow, the trading day, it would be the 10th. And we like to look 10 days into the future for what's coming up in the next 10 days. So that, my friends, would be the week of the 24th. So we're going to look at this week here and find out who's going to be trading the week. That's actually the last week of July. So that way, it gives us stock time to make the move that we're looking for, and we can get in, get out, make our profits, and be happy campers. All right, so let's quickly just jump on into that. And here we go. We're going to open up our Thinkorswim trading account. Let's go back to activities and positions. Now, last week, we did a couple of covered calls on Colgate-Palmolive and Yum Brands. Didn't quite go the way we wanted to. However, we did bring in $2,200 on Yum Brand and $2,600 on Colgate-Palmolive in the covered call. Now, maybe a little confusing, because over here it says profit and loss since we opened, negative 3,300. That's because the stock moved down in price from when we bought it. Let me quickly explain what that means. Let's go back to the beginning so we're not confusing anyone. Okay, this is a 1-year chart we're looking at. Now, Colgate-Palmolive, right here, see how Colgate-Palmolive started the year trading in the $74 area. So she's going between 73 and 75. She trades in that range for about 2 months, dips down a little bit to the 71, 72 area, trades that way for about 2.5 months also, and then she drops all the way down to 65, 66 for 1, 2, 3, 4, almost 5 months. And then from 66, 67, she jumps back up to the $74 area and moves along again. Why does it do that? I honestly couldn't tell you, but it does what it does. And for us to try to guess where it's going next, well, we can only go by what we know and what we can see in front of us. So that's what she's done for the past year. And here we are right here. This was Friday. She opened up at 73, hit 73.69, hit a high of 73.76, and then closed at 73.34. That's not where we wanted. We wanted a 73.50, I think it was. But anyway, let's quickly take a look. Colgate-Palmolive. View our trade. Okay, now we bought this July 1st. Okay, we ended up getting it at $74. The July 1st was right there. Okay, which was Saturday. So that's what we bought right there. I was kind of hoping that this should be a bottom over here, support. See that? Support over here, and then it should go back up. But I just want to collect the dividend. Now, considering the stock went down and we have 5,000 shares, that's why you're seeing the loss over here at 3,300. When the stock goes back to where we bought it at 74, which should be up to here, this will change to $2,600 because we already made the $2,600. I'm not quite sure if that's right or not. Does it actually count the premium in there or just the stock price? Because we made the $2,600 on the premium last week, and the week before we made another. The week before we bought the stock at a lower price. Okay, so last week we made the $2,600 from selling the option for someone to buy it from us at 74. And I know for you new people this is probably going to be confusing. So let's stop all this nonsense and just get right down to where we are and what's coming up. That way everybody knows what we're doing in this upcoming week. Now, considering I have 5,000 shares of Colgate-Palmolive and 5,000 shares of Yum Brands, I don't have much to do other than just try and compensate and resell it for what I paid for it. So what I'm trying to do is I'm going to go in to the trading section and show you what I'm looking at for the options that I'm going to be able to trade. So go right here, click on the trade button. And that's going to bring up the window, and we're going to jump into Colgate, which is CL. That says right there, and we are going to look at what we paid for it. Now we paid 74. All right. Now we have the option of selling it 73.50s for 45 cents each, or the 74s at 29 cents each. I know 29 cents doesn't sound like a lot of money, but you multiply the 29 cents times 5,000. Okay, that's how many shares we have, and this is how much we get per share. So it's 29 cents per share. Okay, so I can sell the option for someone to buy this from me for this much money. Now, 29 cents doesn't sound like a lot, but let me quickly grab my calculator, and we will see exactly how much that is. Okay, so 29 cents times 5,000. Okay, that's $1,400. Now, I could do that, and hopefully Friday will close before 74. Let's get back to where we were. Right here we go. Okay, so I can collect the $1,400 by selling that, or I can wait until the stock market opens, find out what's going on, and then, because you see this, the difference in the price between here, which is the bid, and the ask, okay, for the 74 July 17, which is this coming up Friday, okay, 14th of July 2017. That's what this stands for. 14th, which is the 14th day of the month, July the month, and 17 is the year. This is the strike price, or the price of the stock projected for Friday. Okay, it can be a little confusing, but we bought it. Okay, let's go back. View trades. Here we go. Okay, we bought it July 1st at $74 per share. And how many do we have? We have 5,000. So you see where I am? 5,000 shares at $74. Now, when we want to trade, we're going to sell the stock at 74. Now you're going to ask me, why would I sell it for the exact same price I paid for it? Well, I am going to be collecting 29 cents per share, which we just went through that exercise, which is going to be $1,400. So I can buy it at 74, sell it for 74, and still make $1,400. How can you go wrong, right? That's the way I look at it. But I'm not going to do that today, and you know why? Well, the price between the difference between the price of 29 cents, what I can sell it for, and 49 cents, what I can buy it for, is called the spread. Now that's a 20-cent spread. So I really can't tell you without any definiteness how much I'm actually going to collect, because it's after market, which means the market is not open at this moment. So these numbers are always crazy when it's not during market hours. So if I wait during market hours, then most likely I'm going to get a better price. So that's probably what I'm going to end up doing tomorrow, is wait and sell it then. Okay, but that's what we're going to do. We're going to end up just clicking on here like that. That opens up this window down here. This is what we call the order. The order is here. One single order to sell 10 contracts of CL the 14th of July 2017 at $74. And this is a call. There's a difference between a call and a put. I don't want to get into that now for those of you who don't know it, but this is what I bought. So this is what I'm going to sell. Now I have 50 of them. So if I just click on here, 50, that's my 50 contracts that I have, and I want to sell it. I think I want to sell it for, I can sell it for 49 cents because that's the value of the contract. I'm probably going to say something. Wait a minute. I can. All right. Let's sell it for 50 cents a share. Okay, we're going to sell it at 50 cents a share at 5,000 shares. That's going to be $2,500. Okay, the maximum amount I'm going to make is $2,500. Okay, so how much do I get out of that? I get $24.55 because they take $44 out for commissions. All right, so I'm going to send that off, and hopefully, first thing tomorrow morning, that will get filled. We don't know. Okay, so that's that one. What's the other one that we have? We have Yum Brands. So let's quickly take a look at Yum Brands. Okay, here's Yum Brands, and this was just a tiny bit extremely frustrating on Friday. She starts out the year at 61, right around the $62 area. And she moves sideways between 61 and 65 for about 9 months. And then she breaks out 66. It goes all the way up to 73 area, which is where she is now. Now, we bought these last week, the same day we bought Colgate. We bought these on the 1st of July. Okay, 5,000 shares at $73.50. And what is it now? It is at $73.49. So Friday, this thing was going between, it opened up at 72.77 and it hit a high of 73.75. And we had the option of selling it. We sold someone the option of buying it from me for $73.50. And you know how frustrating it is for it to hit $73.49? Oh, extremely frustrating. Anyway, so what I'm going to do is I'm going to do the exact same thing that I did with Colgate Palmolive. I want to sell someone the option of buying it from me for the exact same price I paid for it, which is $73.50. And I think we're going to go back, same thing we did the last time. The order pops up here. I want to change this to 50 because I have 50 contracts of Yum, the 14th, which is this Friday coming up, of July 17th, and the strike price, what we're going to sell it for, is $73.50, which is the exact same price I paid for it. And what am I collecting? I want to collect 50 cents a share. There we go, 50 cents a share, and that should be another $2,500. Yep, see that? $2,500. So I'm going to explain to you in a really quick second. So sending that one off also. Great. Let's quickly take a look at what we just did. All right. Now, let's quickly take a quick peek at what I just did and explain to you why I did it. Open a few trades. All right. July 1st, we bought Yum Brands at $73.50. All right, that's what I paid for it. $73.50 per share. 5,000 shares. Okay, follow me so far? That was right there. Right here. Here we go. $73.50. This is where I got it. This was Friday. This was Monday. Okay, so options expire on Saturday. So that's the day you get filled. You get filled on Saturday morning. That just happened to be when I got filled, 73.50. Now, I could have sold it on this day for a little bit of a profit, but I didn't. What I did is I sold someone else. I sold someone else the option to buy it from me at 73.50, and I believe I took in 45 cents per share, which is right around $2,200. That was last week for Yum. Now, had Yum went over 73.50 when it closed on Friday, I wouldn't be owning it anymore. Somebody else would own it. Okay, so now I still own it, and it's at 73.49. So I'm selling it to someone else at 73.50. That means I gotta wait until Friday. If the stock goes above 73.50 on Friday, then they will buy it from me. But if it doesn't go above 73.50, then I'm gonna end up keeping it, like I did last week. Now, how frustrating is that? Because I'm sitting there watching it at 3:30. I don't know if you saw the last video I just did last Friday. I'm sitting there watching it going between 73.50, 73.49, 73.47, 70. It was extremely frustrating. I was seriously thinking about buying back the option at 2-3 cents and just selling it as it is. But that would take me out at $2,500 for this week now, wouldn't it? Okay. I forget where I was and where I was going. But, okay, so those are the two trades I just did. Now, interesting thing about that is I bought it for 73.50, and I'm giving someone the opportunity to buying it from me at the exact same price. Now that is the reason I did that is because I just want to collect the premium. I really don't care which way the stock goes. If it goes up, great. If it stays the same, great. If it goes down a little bit, hey, that's fine too. As long as I collect the premium, somebody buys it from me at that time. So, that being said, let's move into what is coming up this coming up week. Alright, so we get to the market watch. Let's clear the filter. Now this is what we have showing coming up this week. Alright, now tomorrow is the 10th, and we like to look 10 days ahead of time. So that would be this 24th. Okay, so these 7 companies are on the list for tomorrow. Whoops, that's the 10th. I don't want the 10th, I want the 24th. Okay, so we have 2 companies, Lowe's and RY. What is RY? Royal Bank of Canada. Okay, so let's take a look at RY. RY, which is Royal Bank of Canada. Now, Royal Bank of Canada starts the year out at the 63 area. She trades about 4.5 months there. Then she shoots up. Is that what I think it is? Yes, it is. Look at that. Trade sideways for a while, and look at this day here. Green, green. Let's open that up a little bit. Look at that movement. And what is this date here? Does anybody know what that date is? You guessed it. The day before the election. And this stock went from 61 up to 75 after Donald Trump got elected. Hey, everything went up once he got elected. I'm sorry, I shouldn't say that. Not everything, but a lot of stuff. A lot of stuff. Massive, drastic increases. Now, is there any substantial reason why it did that? I don't know. I really don't care. Okay? I should care, but I don't care. Okay? You buy the stock, make a profit, get out. Isn't that why we're here? Yes. Okay, so Royal Bank of Canada went up right at the election. Nice movement. All right. Okay, and for some strange reason, in the middle of February, she came tumbling back down to 67, and then she retraced back up to 73, where she is now. Now, this is nice movement. Okay, now does it have space to move another 64 cents? Of course it does. Okay, now I'm going to show you a nifty little trick. Not really a trick, but it's something that not everyone does. Click on this little icon here. This window drops up. I want to come to the chart mode. Well, slide on over to the right where it says standard. Slide down where it says seasonality. Now, seasonality, I have mine set for 10 years. I want to look at 10 years worth of data compiled on top of one another. The blue line represents the way the stock is moving right now, from January 1st to where we are today. Down here, this red line is a composite, or an average of the 10 years of movement, the last 10 years. How the stock has moved continuously for the last 10 years. This is what it did. Okay, now, here's where we are this part of the year here. Now, what is the stock about to do in the next couple of weeks? You guessed it, right here. She is going to move up, see? Now, this is not guaranteed. This is just how it performed over the last 10 years. Last year, the year before that, year before that, year before that. Compile on top of one another. Has a tendency to go up for the next couple of weeks. Great. I'm in. Why not? However, RY doesn't have weekly options. They only have monthly options. So not really worth me trading. I don't know. Let's quickly take a look. RY, Royal Bank of Canada, and we have 12 days. All right, let's go back to the standard chart so we know what we're looking at. Okay, here's where we are right now. So the stock is in a nice upward movement. However, Friday, this is what they call a doji, where it opens and closes at the same price, or very close to the same price. All right. Okay. Come over here to this option chain. Slide on over. It says spread. It says single. Click on that, and this drop down opens up. I like doing the verticals. Now I can do a credit, or I can do a debit. I'm going to go for the credit. I'm not, sorry. I'm going to go for the debit spread so I can see what I'm looking at. Now, she closed at 73.80. So, what I would pick would be right here. Yeah, right here. But, as you can see, there's no money there, because the spread is between 65 and 70. It's a $5 spread. And how much they want for it? They want $5. So if I go here, the next one down, it's still a $5 spread between the 70 and the 75. And how much they want for it? They want $3.65. So your break even would be $73.65. So you only get like a 15-cent incentive to invest in that. Now, to me, I wouldn't do this. Now, let me explain to you why. Because you make money, in my opinion, when you buy the stock. If you have an idea of where it's going to go. If you think it's going to go up, you buy it and you see what it's going to do. Then you sell it. That's the reason why we buy and sell, to make the profit. Now this spread in particular, 70-75, means I don't make any money unless the stock goes up. If the stock stays the same, I make nothing. If the stock goes down, I make nothing. I don't want to do this trade because there's no profit already built in. Now I'm going to show you a few more trades where the profit's already built in. Okay, so we make money if it goes up, if it stays the same, or even if it goes down. So the stock can move any direction and it would still make money. Those are the kind of trades I want to do. RY, hey, it might go up, but then you're betting that it's going to go up, and you only make money if it goes up. So if you're wrong, you don't make anything. Okay, if it stays the same, you don't make anything. It has to go up in order to make money. That's not the kind of trade I want to do. Okay, so let's go back. What else do we have? We have Lowe's. Gotta love Lowe's. You know why I gotta love Lowe's? Because Lowe's is a dividend king. L-O-W, Lowe's. Now, a dividend king is a company that has been increasing their dividend payments to their investors for a minimum of 50 years. Yep, that's right. 50, 50 years. Okay, constantly increasing the dividend payments to the investors year after year after year. And those are the companies I like. And it has weekly options. All right, now so let's see if we can find one of those trades that we just talked about. Quickly, let's take a look at the chart. Lowe's starts the year off 82, goes sideways for about a month and a half, drops down for about another month, 77 area, drops down to 71, trades that way for about a month and a half, 71 area, and then she drops down to hit the low of the year at 66, trades there for about half a month, then slowly goes all the way back up, back up, back up. There we go. And here we are where we are today at the 77.15 area. Alrighty, so the chart's not the greatest looking in the world, and let me go back just 1 second to show you this real quick. When I invest in a dividend company, I don't want to be at the very bottom, way down here, when the stock's going down. That's like being in the basement digging a hole. Or I don't want to be up here at the high of the year, because you're standing on a ladder reaching for the stars. I don't want that either. I want to be in between the high and the low, somewhere in the middle, which is exactly where she is now. Where she's going from here, nobody knows. Do I know? No, I don't know. I don't really care where it's going. I want an idea of where it might be going. Does anybody know where it's going? No, nobody knows where it's going. So let's quickly take a look at, this is where she is, and let's take a look at that seasonality chart like I told you a little while ago. Click on here, this little icon, slide over to chart mode, get the seasonality. Here we are. This is Lowe's as it is right now. As you can see, it goes up, back down, so it's not at the low and it's not at the high, it's somewhere in the middle, which is good. I like that. Now, where's she going to go the next week or so? Let's click here and drag to the right. That's isolating that little spot. Let it go, and there we are. So, this is where we are, and this is where she's possibly going to go. Go up a little bit and then sideways. Up and sideways. Get that? Up and sideways. So, what I want to look for, I want to look for a trade that's going to make me money if the stock goes up and sideways. Up or sideways. Okay, so she's at 77 at the moment. 77.15. So I could get this one here, but then the stock has to go up. Okay, 77.15. And this is the 77.50. Now, if I do this one here, the 76.50, 77, the price is already built in. And look, click on here and see what I can buy it for. Yes, I like this. However, I have no money to buy it because, as you saw earlier, all my money's here. I'll show you. All my money's tied up in here. Okay, so I got 5,000 shares of this, 5,000 shares of that. If I can't make the 2,500 on the options come tomorrow morning, I might think of selling this at the market and then going in and doing Lowe's. All right, so let me show you. Here's where she is now. Now, seasonality tells us that it should be going up in the next week, or going sideways, up and sideways. Okay, remember, quickly back again. Okay, here we are. See the crossroad is right there? Between here and here, right there. Okay, the red line is up and then sideways. Up and sideways. Right. So we want to make sure the profit's already built in. Let's go back to where I was. There we go. All right, so if I buy, this would be sell, and this would be buy. See how the little thing open right there? See how it says sell, and how that one says right there buy? Okay, so if we buy that, we'll be paying 32 cents per share for the spread. Let me explain that a little bit. These are two separate trades. It's one trade, but it's actually two separate trades. See, you're buying 10 contracts of Lowe's, 14 July 17, which is the 14th, which is Friday of July, the month, 2017, the year. Okay, so I'm buying 76.50, which is, I'm buying the stock for $76.50. You got that? $76.50. I am simultaneously or instantaneously selling 10 contracts of lows for Friday, July 17th at $77. So I am buying it for $76.50, and then I am selling it at $77 at the exact same time. So what is the difference between the two? It's only 50 cents. Okay? So I am buying my profit. I'm buying my 50-cent profit. Do you understand that? Okay. How much am I paying for my profit? I am paying 32 cents. Okay, so my profit is 50 cents. And I'm paying 32 cents for that 50 cents. It's kind of like taking a 50-cent piece. Remember those years ago they had half dollars, the Kennedy half dollars? Okay, it was worth 50 cents. It's like buying one of those for 32 cents. If you could do that, how many would you buy? Because it's worth 50 cents. And you pay 32 cents for it. So the most you can make is, it's close to 40%, something like that. Okay, it's like a 40% return on your money. So what I am betting, this is my bet here. This is where it comes into play. If the stock stays above 77 come this Friday, I will take possession of my 50 cents. No, my little Kennedy half dollar, my 50-cent piece that I only paid 32 cents for. I get to keep it. If it goes below 77, then I don't get to keep it. I only get to keep a portion of it. So that's why we look at the market on Friday just before close to find out how much my 50-cent piece was worth. Understand? Okay. So this position here, 65, 50, 77, as you can see, it's already profitable. Okay, so if the stock goes up, I make my money. If the stock stays the same, I make my money. Okay, the stock can still go down 15 cents and I would still make my money as long as the stock stays above 77. Come Friday, I will get my 50-cent piece. I think that's a pretty interesting way of looking at it. And you know what? Next time I think I'll bring some props. You know, hold up a 50-cent piece. You know, those old Kennedy half dollars. Okay, because that's basically what we're looking at. We're looking at Kennedy half dollar for 32 cents. Okay, so if I do that for 50 contracts, that's 5,000 shares. How much can I make? Okay, I can only make $900. Okay, $900 is not bad. What is it going to cost me to make $900? All right, it's going to cost me $1,600 plus $81.95 for the commission for a grand total of $1,681. Okay, so that's $1,682, somewhere in there. Round it up a little bit. Now, that being said, the maximum I can make is $900 for my investment. So what return on my money would that be? That is over 50%. Okay? Because $900 is more than half. Well, let's find out. Okay, clear 900 divide, what was that, 1682 divide 1682 equals 53%. I can make 53% on this trade. This is why I love these kind of trades. I can make 53% on this trade if the stock goes up, if the stock stays the same, or if it even goes down a little bit. Okay, and the most you can do is however many contracts you can qualify for. Now you might think to yourself, hey, I have $2,000, let me buy $2,000, let me buy 50 contracts. It doesn't always work that way. You have to get to the point of experience where they allow you to make those kinds of trades. Now I'm at the level 4, level 5, which is I think one of the highest levels you can get, because I've been doing it for a while. Now I'm suggesting if you do this, only do like, you know, I don't know, 5, 10 contracts maybe. Something that you can easily work with and you don't feel bad about, because the flip side of this is my break-even point is 76.82. So this thing can drop all the way down to 76.82 before I actually lose money. And I don't want to lose money. Okay? As long as the stock stays above 76.82, I'm profitable. But I want it to stay above 77, which, like I said, if it goes up, I make money. If it stays the same, I make money. If it goes down a little bit, I still make money. As long as it stays above 77, I make 53%. That's why I like these kinds of trades. Granted, it's not a whole heck of a lot of money. It's, you know, I got to put up $1,600 to make $900. It's still 53% return in 5 days. That's 10% return a day. I can deal with that. Wish I could do more. Unfortunately, I can't, because all my money's tied up. Alrighty then, let's get out of there. I might think about that, you know. I don't know. Alright, I can't do this one, but those are the kind of trades I look for. Now you can do that on weekly options. Alright, let's jump into the next one. Market Watch, see what else we can find. Okay, that's for Monday. We only really have 2 to look at Monday. Tuesday, we don't really have anything. Really, no stocks giving a dividend on Tuesday. All right. Wednesday, we got 1, 2, 3, 4. I don't even know these companies. Let's quickly take a look at what they are. TEP is Tallgrass Energy Partners. Oh, Tallgrass Energy Partners. Never heard of them. I feel bad, but they're paying 92 cents per dividend. Let's give them a quick check, see what they are. TEP. TEP, Tallgrass. All right. It's not a bad looking chart. Let's see what they offer. Okay, Tallgrass starts out the year at 43. Gets into a trading range of 44 to 49. Trades that way for about 6 or 7 months. Gets that nice little trend up to the high of the year of 55. Comes back down, trades a little bit in the 52 area. Makes a little bit of a retracement all the way back to that 45. So it looks like there's pretty good support way down here in the 45 area. But she's at 50 right now, 50, 51. Now, I don't think they have options available or weekly options. So let's go TEP and see what it says. TEP. Okay, so they get weekly. They have monthly options. It's 12 days for this option to expire. So if I buy the one that I would normally buy, like I just showed you a moment ago, let's see what we'd be looking at. She's at 51, so we would go to the 50, which is right here. $2.40, and it's only a $2.50 spread. Okay, so do I want to pay $2.40 for a $2.50 spread? No, I don't. And I don't want to wait 2 weeks. 12 days is 2 weeks. That's more than 2 weeks. Is that right? Let's quickly take a look at that calendar. Okay, first Friday, second Friday, third Friday. Wow. Well, that's 2 weeks. I'm sorry. I don't want to wait 2 weeks. All right. So that's why I do weekly options. Because you get more profit a lot quicker. Well, don't get me wrong. I could always lose. I did lose once in a while. All right, let's go back to the chart. Okay, so they're not going to do any good. Let's just skip all these and just go to the ones that offer weekly options. Okay, I click on this little wheel here, come down to public and through W. Now the window opens up, slide all the way down to the weeklies. Okay, so we have nothing coming out until Thursday and Friday. So you have Lowe's on Monday. Thursday we have 2, and Friday we have Hasbro. All right, so let's take a look at these two. HIMX. Himax Technologies. Never heard of them. HIMX. HIMX. Okay, interesting looking chart. Okay, so HIMX starts the year off at $8. Wow. That is a very, very high return on investment. Kind of makes me leery. All right, 24 cents. It's an $8 stock. All right, she starts off the year at 8.31, makes a high of 10.90, and then she drops all the way down to 4.90. That's that is a 50% decrease between end of September to the beginning of February. Wow. Okay. Then she jumps up and settles into the range of where she is now at $8.16. I had a bad feeling about this one. Let's take a look at the seasonality. All right. Kind of looks like the chart. Look, starts off high, beginning of the year, makes a dip, then recovers, and then goes back down, then it recovers again. Okay, so here's where she is right now. All right, so she's going to dip a little bit, then shoot back up. So that might be a one for this week. All right, so let's see what they're offering. All right, and that is HIMX. HIMX, here we go. All right, so HIMX, let's delete that. Delete this. All right, so she's at 860. So this is the one we're looking at right here. All right, not worth my effort. Okay, paying 45 cents for a 50-cent piece. No thanks, it's not worth it. Now, if we go to the next one up, one thing, you know, it's 25 cents. Yeah, nice price. However, look at the spread. 10 and 35, that's a big spread. It's not accurate. And this spread here, not accurate either. That's a 35-cent spread. So it might get a better spread tomorrow. Might close the gap a little bit tomorrow once the market opens. I don't know. But the way it looks like now, and the reason why I don't like this one, because the stock right now is at 816. If you buy the 8 to 850, the stock has to move up. Has to. Got no other choice in the matter. Now, however, for the more advanced people out there, if you're paying 25 cents for this option and the delta is at 33, every dollar that stock goes up, you make 33 cents, which means if the dollar goes up, if the stock goes up a buck, you more than double your money. But does it have that potential to go up from 816 to 916? Probably not. Look at that. Right now it's 815. 916 is right off this chart, way up there. It just doesn't look right. I'm not going to do it. All right, so this one, if it, you can only make money if the stock goes up. That's it. If it stays the same, you lose. If it goes down, you lose. So no, HIMX does not have what I'm looking for. And this one right here, overpriced. So we're out of that one. And then EPD. Who's EPD? Enterprise Products Partners. Never heard of them. But let's take a look and see what they do. EPD. EPD. Okay. Interesting looking chart. Starts the year off 29, up 30. That little area drops down to this trading range between 24 and 28. It's basically sideways all year round. Made a high here, 30 bucks, 30.24. Right, end of January, and a low of the year, 24. Between 24 and 30. That's it. Okay. She settled back down to the $26 area, and right now she's at 27.24. Okay, what does she look like she can do for the rest of the year? Okay, here's where she is. Okay, that's where she is. Well, that's a good signal. Looks like she's going to go up. Alright, so EPD. EPD. Let's get rid of this. Okay, she's at 27.24. All right. So that would be this one right here. Again, this is even worse than the last one, paying 45 cents for a 50-cent piece. And look at the spread, 25 to 60. This one might be better off taking a look at this one sometime tomorrow. You know, so when the market opens, because this should be somewhere in the 30s. Yeah, it should be somewhere around 30, 35, somewhere in that area, and that makes it worth it. But this here, this is not worth it. Okay, it's difficult to do options after hours because the price is so skewed. You know, like look at this, the stock price. You want to sell it, you can sell it for 26.18, but if you want to buy it, it's 27.44. It's a huge spread. The spread should be a lot smaller. When spreads are this huge, it usually means not a lot of trading going on. Okay, let's jump out to the next one. Or I'm going to show you something that I usually don't show people. If I go here to the layout and I click on here, all right, I can get next, last, net change, theoretical price, the mark, the volume, open interest, implied volatility, all this stuff. This stuff can be very confusing. I could customize one for myself. Do I know how to do it? No. Do I want to know how to do it? No. I just want to know how to use what I already have available, and I don't need to know new stuff. Okay. Let's go to implied volatility. No, volume and open interest. That will tell you how many contracts are already out there. So at this moment in time, how many contracts for the 27th? This one, the one we wanted? None. Nobody's buying them. Why do I want to be the only one there? I don't. All right, so let's get out of there. Let's go back to where we were. Delta Gamma. Why do I do the delta? Because I like to know how much the stock is going to move, how much the options are going to move if the stock goes up. Who's next? EPD's a no-go. Hasbro. Hasbro's got to be a good one. It is Hasbro, isn't it? Yeah, Hasbro. Okay. HAS. Hasbro. Well, come on. HAS. There we go. Ooh, now this needs some explaining to do. All right, she starts off the year 85, so between 77 and 85. She trades 7 months, 8 months, something like that, and she gaps up 82 to 97. That's a $15 move. That's a big move. That's almost a 20% move with overnight. From 82 to 94. Yeah, it's about 20%. Okay, trade sideways for a little bit. 95, 96 area. Jumps up to where she is today. She's trading sideways at 112. That's what we call sideways. Yeah, 111, 112 area. Right there. That's where she is now. So she got the dividend coming up. Let's see what the seasonality looks like for Hasbro. Here we go. Okay. She looks like a sideways stock. Look. Right there. Going to go up and sideways. See that? That's where she is now. Okay. Up and sideways. Now we saw this earlier with the other one that we were going to buy. So let's go here. HAS. 111. We're looking at the 110, which is right there. 109, 110. Oh no, sorry, that 110, 111. Now that's not that bad. However, take a look at the spread. 20 cents to sell and $1.20 to buy. That is crazy spread. This spread is going to get a lot tighter when the market opens. This might be one to look at. Quickly go here and find out how many people are buying. At the moment, there's none. I don't know if this is open interest or implied volatility. 11, 20%. Doesn't really give me anything to work with there. Okay, let's just leave it at that. Okay, so here's where we are. Go back, open that up. Back to where we were. Okay, the 111, 112. Now, see where she is now at the 111.93. Okay, if I got this one right here, okay, the 111, I would be paying 74 cents for $1. What does that mean? The spread, or the difference between what I am buying, 110, and what I am selling is $1. 100, I buy it for 110, and then selling it for 111. That's it. It's as simple as that. That's what the spread is. How much I'm buying it for, how much I'm selling it for. You buy it for $1, sell it for $2. In this case, I'm buying it for 110 bucks, selling it for 111. Now, is that a lot of money? No, it's not a lot of money. However, let's look at what it is that we're actually buying. We're paying 74 cents for this $1. That's a dollar bill. All right, here we go. Dollar bill. Paying 74 cents for a dollar bill. However, the catch is you can't have this $1 until Friday. Okay? When Friday comes, you collect $1 and I get the 74 cents today. That means you're giving me the 74 cents today, but I'm holding on to this until Friday. That's basically what we're doing here. Now, I like doing 50 contracts, so let's put that up like that and find out what we're going to get. $1,300 is the maximum I can make off of that trade. However, that trade is going to cost me $3,800. Okay, so that's $37.82. Wait a second. What was that again? It's just right there in front of me. 1,300. 37.82. Okay. 1,300 divide 37.82. That's probably somewhere around 25%. Oh, 34%. All right. So 34%. Now the neat thing about this trade is take a look at this trade. All right. 111. If this stock stays above 111, I make that 34% for 5 days. Okay, you follow me that? 34%, 5 days, as long as it stays above 111. Where is it right now? It's at 111.93. Stock goes up, I make 34%. Stock stays the same, I make 34%. Stock price goes down, all the way down to 111. I still make my 34%. That's why I like these types of trades. And finding them, you just got to know how to find them, where to look, and of course when. All right. All that being said, it's time for me to sign out. It's been about an hour. Let me check and see if I have any questions. And let's quickly go. No questions. All right. No questions. All right. This is James from Dividend Stock Talk. Where was I? Right here. All right. It is 9:53, Sunday, July 9th. We went over what's coming up this coming up week. Granted, there's not a lot to look at, but I showed you two trades. One you can make 34%. The other one you can make 50. I forget what it was. Yeah, it was like 15 minutes ago. I already forget what it was. All right, 50% on one trade, 34% on the other trade. You guys do your homework, do your research, find out which one's best for you. This is James signing out from Dividend Stock Talk. If you're not a subscriber already, hey, come on, be a subscriber. You can get these things emailed to you and you can take advantage of them. All right, peace out and catch you guys next time.